All right, going over the topic immediate rebalance. And what is an immediate rebalance? An immediate rebalance is a failure to create a fair value gap, but still continues in the same direction. So if we take a look at the examples that we have on the bottom, then we start off on the left one, the bearish example. How a fair value gap normally gets created is we have the first candle. The first candle can again do whatever it wants, right? Then we have the second candle right there. The second candle creates an expansion phase candle because it's expanding below the first candle low, actually creating the future fair value gap. Now the third candle, how the third candle closes, that is going to create the fair value gap or not going to create a fair value gap. So if the third candle trades back into the first candle low, like we see in this example, then that creates an immediate rebalance where the fair value gap, the future fair value gap, gets immediately rebalanced right there, and then we actually continue lower. So sometimes this happens where we might be waiting for a fair value gap, we trade back into the first candle low, so we don't create the fair value gap, but we still continue in the same direction. Now, a lot of people get caught off guard, essentially, because they think, all right, well, if we don't create that fair value gap, then we must now continue higher, or there's no bearish intention anymore. But that's not necessarily true. Now, if we take a look at the bullish example, it's the exact same, of course. First candle can do whatever it wants. We have the expansion phase candle, it's the second candle, and the third candle trades back into the first candle high right there, actually already filling in the full future fair value gap that we would have had, and then still continuing higher right there in the same direction. Now, how can we understand and how can we trade these immediate rebalances? So the first question right there, can we trade this? Yes, we can. We can definitely look to trade this. Is this a little bit harder to trade? Yes, potentially it is, but we can trade this. All right, second question, how? Argument, counter argument. So what happens in this example? We fail to create a fair value gap. That is essentially, in the bearish example, that is a bullish argument, right? Because when we fail to create a bearish argument, there's something going on. Some kind of bullish intention might be there. So if we get some bullish intention, then we need to take that away with a counter argument. So what are counter arguments to that bullish argument right there? Well, that is the following. Question 3 and number 4 answer those. Candle signs right there and order flow. The third candle can be a rejection, and order flow we respect lower time frame fair value area and fair value gaps. So to show you the example in the first slide again, based on candle signs right here, we are still rejecting lower at that moment in time. So we open up with that candle, we continue higher a little bit, and then we reject lower again. That tells us that that bullish argument is still nowhere to be found. So we have a good counter argument in the form of a bearish rejection. Now, that bearish rejection is of course seen through one singular candle right there, but if we go into the lower time frame, then that will be seen through order flow, most likely respecting a fair value area or respecting fair value gaps to then simply continue lower, which leads to the failure to create a fair value gap, but it never changes the overall order flow, never changes the true intention of price action. So let's look at a few examples. All right, here we are on crude oil. Now, in these scenarios, it is, of course, it works the best when you already understand where price action wants to go. So this is just when we have a bias, we have a clear drawn liquidity, so we expect higher prices, for example, then we understand, all right, if we don't create that fair value gap, it's not necessarily a sign that we need to move to the sidelines or that we can't get involved anymore. No, because if the intention is still there, then we can still get involved. Now, right here, we see a fair value gap is about to get created, potentially on the 4 hour right there. And then with the next candle, what do we see? We see a rejection lower right there, and we immediately continue higher again. With, on the 4 hour, a big rejection candle right here, still continuing higher. So even though we don't create that fair value gap, there's still bullish intention, simply seen from the perspective of candle signs at that moment in time. Now, this candle signs perspective is the exact same on lower time frame, just through a different lens. Because now, if we go into the lower time frame, it is not candle signs anymore, but it turns into order flow. So inside that singular candle, what actually happens? On the 1 hour right here, we are simply respecting a 1 hour fair value area right there, although we do wicked, yes, and we are coming into a fair value gap right there, and then afterwards we continue higher as well. And if we go into the 15-minute, for example, then what happens right here? We simply have a beautiful 15-minute sharp turn, we have a sting into the sharp turn fair value gap right there, and then afterwards we simply continue higher again. And what is important to understand right here? It is important to understand the signs of a potential consolidation, because when we do not create this bullish fair value gap right here, the only thing that the first thing that we might assume is, we do not create a bullish fair value gap right there, we might want to continue lower, or we don't have bullish intention and bearish intention, and we might create a consolidation. So what is important to spot right there, if we go into the lower time frame, okay, well, do we have still a good 2-candle rejection on the 1 hour, for example, off of those fair value gaps? Do we still respect new fair value gaps? Do we even create new fair value gaps? And everything here on the 15-minute and the 1 hour, if we didn't have that understanding of a 4-hour potential fair value gap being created, everything looks perfectly fine. We are perfectly respecting fair value gaps. We have bullish fair value gaps created. We respect them perfectly based on 2-candle rejection. So there's no clear signs that we might actually want to consolidate right here. So the overall intention is still very much bullish. And what I mean with the argument is, at this moment in time, when we create or we don't create the fair value gap right there, we actually have some bearish arguments right there to be created. But those bearish arguments are quickly taken away as soon as we have this new rejection higher. As soon as we have new confirmation on the 50-minute, for example, that we do again want to continue higher. So if we don't create a fair value gap, and it is an immediate rebalance, if it's an immediate rebalance, that means we will also immediately see intention again going into the same direction. Meaning, if it's a bullish fair value gap, we fail to create that bullish fair value gap, and we still have intention towards the bullish side overall, so there's no real bearish arguments to be created, perfect. That's an immediate rebalance, and we can still look for higher prices as well. If that's not the case, and we, for example, don't create the fair value gap right here, and it was a different scenario. So we don't create the fair value gap right here, and instead, we don't create a rejection on the next candle or anything, and we just keep on continuing lower. That is a sign that it's not an immediate rebalance and that we actually do want to continue lower and don't want to follow through higher. But if we do, like this example, immediately rebalance the whole fair value gap that is about to be created, and we still have bullish intention, we can simply look still for trades in the same exact direction. Now, if we zoom out and we stay on crude oil, we actually see it potentially happening at this moment in time. So that could be a very interesting case study, where here, at this moment, we create an expansion phase candle on the daily time frame to potentially continue higher. Now, on the next day, we all of a sudden have a big rejection going lower right there, filling in the potential fair value gap right there, going back to the first candle high. Now, this next day can potentially still continue higher if we get a rejection just like normal, even though we do not create that fair value gap right there. So here on the 4 hour, we see that we, at this moment in time, we still perfectly fine have a rejection off of this 4 hour fair value area right there. And that is what tends to happen. When we create an immediate rebalance and we still look to continue higher, it is just a lower time frame play. Meaning, it's just an order flow play where we come into a lower time frame fair value area, lower time frame fair value gap, to then still continue higher. It just happens to be that on the time frame above, it fails to create a fair value gap at that moment in time. So if we still want to continue higher right here, then we can perfectly fine still continue higher at this moment in time. But if this wants to be an immediate rebalance, then it should continue higher right here at this moment in time. If this is not an immediate rebalance, and the difference between the two is again, if we now start to create new bearish value gaps to continue lower. Again, we now have a bearish argument. Because we have bullish intention, we ideally want to see only bullish arguments, but we have a bearish argument created because we now have a failure of a bullish fair value gap. We don't create that new bullish fair value gap that we would like to see. That is a bearish argument. But to continue bearish and to add on to that argument, we need more bearish intention. Because if that bearish argument is now followed by a lot of bullish arguments where we create new bullish fair value gaps, then the bearish argument is not valid anymore. It's not relevant anymore. And that is very important to understand. Now, when you start seeing and noticing those third candles, how they actually form, you'll start seeing it more often as well, and you'll be able to anticipate it. Now, right here, we have a few examples actually, because on the left side, we also have this example right here, expansion phase, and we already continue higher. Through candle signs, we just simply see a rejection candle at that moment in time. Here, for example, we have a little bit of a different example, but very similar, where we create a very small weekly fair value gap. And that small weekly fair value gap, I would argue, is very similar to an immediate rebalance, because I would not want to trade off of that very small weekly fair value gap. But we can see it already rejects higher at that moment in time. So what happened on the daily time frame? On the daily time frame, we are already respecting a fair value area right here at this moment in time. So we can already potentially look to continue higher instead without coming back to the weekly fair value gap right there. So reading that third candle and understand what we are doing on the time frame below, those things are the exact same, because the candle signs is an understanding of order flow. And order flow is then also that translates over to an understanding of candle signs. Understanding this can be extremely beneficial, where you don't get lost in the fact we are not creating a fair value gap, but we are still continuing overall towards my drawn liquidity. Yes, perfect. You can still perfectly fine capitalize on it. So extremely valuable if you do start noticing it, and extremely valuable as well to do your own case study around it. For example, on the crude oil for this week. All right, perfect. Thank you.